Welcome back to the Deep Dive. Today we're tackling something absolutely fundamental if you want to understand how companies talk about their performance. We're looking at the statement of profit or loss and other comprehensive income. Think of it like the company's report card for the period, right? But as we'll see, the rules for putting that report card together, they can differ quite a bit. We've got a great comparison document here today. It really lays out how the two big accounting frameworks, IFRS and US GAAP, handle this key statement. It's kind of like having the blueprints.
That's a good way to put it. And our mission really is to unpack those blueprints. Understand the core structure they share, sure, but then really zero in on those key differences, the ones that can actually change how you interpret a company's results.
Yeah, it's like different financial dialects.
Exactly. Different ways of telling the same underlying story sometimes.
And honestly, some of the nuances are, well, pretty surprising. You wouldn't think something like where an expense shows up or what you call an unusual event could be so different, but it is.
Okay, let's start at the very beginning, the big concept, comprehensive income. And here, thankfully, both IFRS accounting standards and US GAAP are on the same page with the basic definition. Comprehensive income is essentially the total change in a company's equity, its net worth, during a period from everything except transactions with the owners themselves. So it excludes things like issuing stock or paying dividends.
Right, so it's all the other value changes.
Precisely. And this comprehensive income gets split into two main pieces. You've got profit or loss, which you might know as net income under US GAAP, and then you have other comprehensive income, or OCI. Now, OCI is specifically for those bits of income, expense, gains, losses that the rulebooks say should bypass the main profit or loss calculation. They get reported separately.
Okay, but why? Why pull things out of the main profit number? It sounds a bit like hiding things.
Well, it's not meant to hide things. Think of profit or loss as let's say, the headline news from core operations. OCI captures other significant financial changes happening, things that definitely affect the company's overall value or equity, but maybe aren't directly tied to that period's main operating performance.
So like background changes that are still important for the total picture.
Exactly. Important context. And while IFRS doesn't really use the term accumulated OCI on the balance sheet like US GAAP does with AOCI, both systems track the running total. It builds up over time in the equity section.
Got it. So we know what the pieces are. How do companies actually, show this stuff? What does the statement look like?
Well, there's some flexibility, actually. Both standards give companies a choice. You can have one single statement, the statement of comprehensive income that shows profit or loss first, then list out the OCI items to get to the total comprehensive income figure.
Okay, one combined statement.
Or you can do it in two steps. First, a separate income statement just showing profit or loss. And then, immediately after, a second statement that starts with that profit or loss number and then details all the OCI components to arrive at total comprehensive income.
So either one big statement or two connected ones. Both allowed.
Both are fine under IFRS and US GAAP, but here's where things start to diverge a bit more, especially on the details of the presentation. Under IFRS, the main standard, IS1, it lists certain things that must be shown as separate lines: revenue, finance costs, tax, things like that. But it doesn't dictate a super rigid fixed order for everything. There's some leeway, although practice often follows IS1's example order.
Okay, so some required items, but a bit of flexibility on the exact layout.
Right. Now, contrast that with US GAAP, especially if you're a company registered with the SEC in the US.
The regulators step in.
They certainly do. SEC rules, specifically Regulation SX, get very prescriptive about the format and the minimum line items companies must show. And they often have different rules depending on the industry.
Oh, really? The specific formats for banks versus manufacturers.
Exactly. Banks, insurance companies, commercial businesses, they might all have slightly different mandatory layouts under SEC rules. Now, if you're a U.S. company not registered with the SEC, the US GAAP guidance is less rigid on format, more like the IFRS flexibility.
Wow. Okay. So who you report to really matters for how the statement even looks. All right, let's drill down then. What about fundamental things like revenue and expenses? How do they show up differently?
Good question. Let's start with revenue. The definition income from ordinary activities is pretty similar across both frameworks. But under IFRS, showing revenue as its own separate line item on the face of the statement, that's required.
Always a separate line for revenue under IFRS.
Yes. Under US GAAP, though, that specific requirement for a standalone revenue line on the statement face, it mainly comes from those SEC rules and Regulation SX, so it directly applies to SEC registrants.
So a non-SEC US GAAP company might not have it as a separate line.
Technically, there isn't that same general requirement in US GAAP itself, though most probably would show it. But both standards, of course, allow for much more detailed breakdowns of revenue in the notes to the accounts.
Okay, subtle difference there. What about expenses? You mentioned that earlier.
Yes, expenses are a really noticeable difference in presentation. IFRS requires companies to analyze their expenses in one of two ways. Either by nature, so grouping costs by what they are, like depreciation, salaries, materials used.
The type of resource consumed.
Precisely. Or by function grouping costs by what they were for, like cost of sales, selling activities, administration.
The purpose of the expense within the business.
Exactly. And you have to show this analysis either right on the statement or clearly in the notes.
Okay, so IFRS forces a choice.
Yeah.
Nature or function. What about US GAAP?
Well, US GAAP, generally speaking, has no such overall requirement for all companies to classify expenses by nature or function on the face of the statement.
Really? No general rule?
No general rule. Now, again, the SEC steps in for certain industries and mandates specific expense classifications, and those SEC rules might look different from either the nature or function approach common under IFRS.
So comparing something like operating expenses or cost of goods sold between an IFRS company and a US GAAP company, not straightforward.
Not always, no. You really need to look at the notes or understand the specific industry rules under US GAAP to know what's truly comparable. It's a significant practical difference.
Definitely sounds like it. Okay, moving on from the regular stuff. What about things that are, well, not regular, unusual transactions or events?
Right. First point of agreement, the term extraordinary items is dead, gone. Both IFRS and US GAAP prohibit using it.
Okay, no more extraordinary. Good to know.
But they handle things that are unusual or infrequent quite differently. IFRS doesn't actually define these terms formally. It just suggests that if an item needs highlighting for users to understand performance, it could be presented separately, but this should be rare. And importantly, under IFRS, just presenting something separately doesn't automatically make it unusual. Also, if you're classifying expenses by nature or function, any unusually large amount of, say, depreciation just goes into the depreciation line. It doesn't get pulled out separately just for being large or infrequent.
Okay, so IFRS is more about relevance and less about formal definitions here.
Kind of, yeah. US GAAP, on the other hand, does define unusual items, things that are highly abnormal and only incidentally related to the usual activities. And under US GAAP, if a material event is either unusual in nature or infrequent in occurrence, you must present it separately within income from continuing operations. And you have to describe its nature and financial effect either right there or in the notes.
So US GAAP has a specific rule to pull these out separately.
Exactly. It's a distinct presentation requirement that differs from the general IFRS approach. Now, both standards do allow companies to add extra lines, headings, or subtotals if they think it makes the statement clearer or more relevant.
So you can add your own lines sometimes.
Yes, but IFRS puts some guardrails on additional subtotals. They have to be made up of IFRS recognized amounts, clearly labeled, used consistently, not be misleadingly prominent, and reconcile back to the required totals.
Makes sense. Rules for custom subtotals.
Right. US GAAP doesn't have quite the same level of specific, detailed guidance on creating these extra subtotals, although the general principles of clarity and consistency obviously still apply.
Gotcha. Okay, let's tick off a few other specific lines we might see. What about an operating results subtotal?
Yeah, showing something like operating income before interest and tax. Both IFRS and US GAAP allow this, but neither requires it. And crucially, neither standard actually defines operating versus non-operating. So what one company calls operating income might include or exclude different things compared to another. Practice varies.
So another area where direct comparison needs care.
Definitely. Another item. The share of profit or loss from investments accounted for using the equity method, where you have significant influence but not control.
Right, like a big associate company investment.
Both IFRS and US GAAP agree here. They both require the investor's share of that investee's profit or loss to be shown as a separate line item in the main profit or loss section. That's consistent.
Okay, good. What about netting things off? Offsetting income against expenses.
The general rule under both frameworks is don't do it. Income and expenses should generally be presented gross, separately, unless another specific standard requires or permits netting.
Keep things separate for clarity.
That's the principle. Or if you're netting gains and losses on similar immaterial transactions. However, US GAAP tends to permit offsetting in more situations than IFRS.
Oh, like what?
A common example is derivatives held with the same counterparty under what's called a master netting arrangement. US GAAP might allow you to present these net, whereas IFRS generally requires gross presentation.
Interesting nuance.
Although some things are handled similarly, like if you have an environmental cleanup cost but expected insurance recovery, both standards would typically have you present the recovery net against the expense.
Okay, now, this next one feels like a biggie, often debated. Those alternative earnings measures, things like adjusted EBITDA or core earnings. How do the frameworks handle these non-standard numbers?
Yes, the non-GAAP or alternative measures. This is a major point of difference, especially between IFRS and SEC-regulated US GAAP. Under IFRS, presenting these alternative measures, like an adjusted profit subtotal, within the actual statement of profit or loss. It's not prohibited.
You can put adjusted EBITDA right on the income statement under IFRS.
Potentially, yes, if it meets those criteria for additional subtotals we talked about based on IFRS numbers, clearly labeled, consistent, reconciled, not misleading, etc.
Okay, allowed with conditions under IFRS.
Now, flip to US GAAP, particularly for SEC registrants. The rules there, Reg G, Reg SK, are much, much stricter. They define non-GAAP measures and generally prohibit putting them on the face of the financial statements.
Prohibited. So no adjusted EBITDA line item on a US GAAP income statement filed with the SEC.
Generally, no. You can present these measures outside the main financial statements, often in the management's discussion and analysis, MD&A section of a report. But even there, you have to follow strict SEC rules, reconcile it clearly to the nearest GAAP measure, explain why it's useful, ensure it's not misleading, and critically, you cannot display the non-GAAP measure more prominently than the corresponding GAAP measure.
Wow, okay. Much tighter control under US GAAP SEC rules.
Very much so. There's also a specific SEC staff interpretation, SFB Topic 7D, that prohibits showing an income subtotal before depreciation and depletion on the statement face for SEC filers.
So even things that seem like logical subtotals might be forbidden.
Exactly. And while non-SEC filers under US GAAP have less formal guidance, practice generally follows suit: keep non-GAAP measures out of the primary statements. And one more really key difference here relates to earnings per share, EPS. Under IFRS, you cannot show an EPS number calculated using an alternative profit measure on the face of the income statement. You might be able to disclose it elsewhere, like in the notes.
Okay, no non-GAAP EPS on the statement face under IFRS.
But under US GAAP, the rules are even stricter. You are prohibited from presenting a non-GAAP EPS figure anywhere in the financial statements, including the notes. Full stop.
Anywhere. Wow, that's huge if you're trying to compare adjusted earnings figures across companies.
Absolutely massive. It means you have to be incredibly careful where you're finding these numbers and how they're calculated.
Okay, fascinating differences there. Let's wrap up by circling back to OCI, other comprehensive income. We said items land there. Do they ever leave? Do they get moved into the main profit or loss statement later on?
Yes, some do. That process is called reclassification, or sometimes recycling. And how this is handled is another difference between the two frameworks. Under IFRS, IAS 1 requires companies to specifically split their OCI items into two groups, right on the statement face or in the notes. Group 1 is items that may be reclassified to profit or loss in the future if certain conditions are met. Group 2 is items that will never be reclassified to profit or loss.
So IFRS makes you flag up front which OCI items might eventually hit the P&L.
Exactly. Examples of things that might reclassify under IFRS include certain gains or losses on foreign currency translation for overseas operations, effective portions of cash flow hedges, maybe gains losses on certain debt investments measured at FVOCI, plus the related taxes.
Okay.
And US GAAP.
US GAAP takes a slightly different approach. It generally assumes that all items initially put into OCI will eventually be reclassified back to profit or loss at some point. So you don't typically see that explicit split between may reclassify and never reclassify categories presented in the same way on a US GAAP statement.
So it assumes everything gets recycled eventually.
That's the general premise. The types of items that do get reclassified under US GAAP are often similar to the IFRS examples: foreign currency differences, cash flow hedges, unrealized gains losses on debt securities classified as available for sale, which is broadly similar to IFRS's FVOCI debt, and their tax effects.
Okay, similar items get recycled, but the presentation of the potential is different.
Right. Although there is one specific item where the ability to reclassify differs. Under US GAAP, depending on a policy choice, certain gains and losses related to pensions and other post-retirement benefits that first go into OCI can later be reclassified into profit or loss.
Pension adjustments can come back into net income under US GAAP.
Yes, under Topic 715, it's a permitted option. Under IFRS, that specific reclassification of pension-related OCI amounts is not allowed. They stay out of profit or loss permanently.
Okay, wow. That was quite the tour through the presentation differences. It's really clear that even with the same goal of showing performance, IFRS and US GAAP have some pretty distinct paths for getting there.
They really do. And as we've seen, it touches everything from how you group basic expenses to how you flag unusual events, and especially how you're allowed to present or not present those non-JAP or alternative performance measures.
Yeah, the same underlying business activity could genuinely look different on paper depending on which set of rules is being followed.
Absolutely. And understanding those differences is just crucial if you're comparing companies across borders or even sometimes within the same country if they use different standards or have different regulatory pressures like the SEC.
It really drives home that reading financial statements isn't just about the numbers themselves. It's about understanding the language, the grammar, the framework behind those numbers.
Exactly. And that brings up, I think, a really interesting question for you to ponder. Given all these differences we've just walked through, especially around expense formats, how unusual as defined and shown, the very different rules on non-GAAP metrics, even the OCI reclassification potential, how much can you really compare the reported profit or loss of an IFRS company directly against a US GAAP company? Without digging deep into those notes and understanding the specific choices made, what does that mean for you as an investor, an analyst, or just someone trying to understand global business performance? How comparable is that bottom line, really? Something to perhaps do your own deep dive on.
That is a fantastic question to leave us with, a real food for thought. Thanks so much for walking us through all that detail today. And thanks to all of you for joining us for this deep dive. We really hope you found some valuable insights into navigating these financial statements.